this kind of alpha that I'm getting from this strategy, it's unique in its own way. So there are multiple ways in which we are looking at it. And obviously, as a whole development of the program takes place, there has to be return drivers from multiple sides, multiple angles, multiple perspectives, without necessarily having commonality or anything like that, or even in the time frame or even in the approach. And this particular stuff blends in very nicely with that program, which is a bit slow, looking at a longer term picture. This is looking at a short term picture, completely different as such. Yeah.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
Welcome to another episode in the Open Interest series on Top Traders Unplugged, hosted by Moritz Seibert. In life, as well as in trading, maintaining a spirit of curiosity and open-mindedness is key, and this is precisely what the Open Interest series is all about. Join Moritz as he engages in candid conversations with seasoned professionals from around the globe to uncover their insights, successes, and failures, offering you a unique perspective on the investment landscape. So with no further ado, please enjoy the conversation.
Hey everyone, it's Moritz here, and thank you for listening to episode number 12 of the Open Interest series on Top Traders Unplugged. Today I'll be speaking with Tillmann Sachs and Vishal Sharma from J8 Capital Management. J8 is a London-based systematic hedge fund, and their flagship global absolute return strategy is live since January 2015. Tillmann, Vishal, and I will be speaking about what differentiates their global absolute return strategy from other CTA and trend-following funds, and how they manage risk across a portfolio of independent quantitative strategies, which includes FX carry, commodity term structure arbitrage, commodity inventory basis trading, and volatility term structure arbitrage. We'll also speak about how one of their most recent strategies, the short-term Redwood strategy, blends into their portfolio. But before we start, let me give you some background on Tillmann and Vishal. Tillmann co-founded J8 in 2012, and prior to that worked in the structured derivative space at Barclays, UBS, and AIG Financial Products. He studied civil engineering in Germany and then went on to complete a PhD at Nanyang Technological University in Singapore. Vishal joined J8 in December 2020, and today is the head of trading and portfolio management. In a prior role, Vishal developed quantitative short-term trading models with Eon Asset Architecture and ARB Trading Group, both prop shops based in London. Vishal holds a Bachelor of Engineering from the Indian Institute of Technology in Kanpur. Let me stop it here so we can move over to the meat of our conversation. Tillmann and Vishal, welcome to Open Interest. It's great to have both of you here.
Hi, thank you very much for having us.
Thanks, Moritz.
You're more than welcome. Tillmann, let's start with you. Interestingly, you are a civil engineer by education, so you're focused on construction and building design and infrastructure planning, all that type of stuff. What got you interested in finance as opposed to construction, and why did you start J8 Capital Management?
Well, during my studies as civil engineering studies, as you know, there are several branches one can go into. And I was very early drawn into the area of construction management and project financing. And within project financing, I then found risk as the most exciting part. And during my PhD, I developed their methodology to quantify political risks in infrastructure project financing. And this eventually led me through multiple steps to my first job in London. So that is really how the link happened from civil engineering to finance.
Okay, and what got you interested in a systematic and rules-based approach as opposed to, trading fundamentally or discretionarily and making investment decisions that way?
Yeah, well, my first job after my PhD was to join AIG Financial Products, or Bank AIG, it was called back then, in London. And the first product group I got myself heavily involved with was, back then it was called the Dow Jones AIG Commodity Index, which is today the Bloomberg Commodity Index. And there I learned really everything around what are futures, how do futures work, how are they being traded, and most importantly, how one can translate a systematic trading agreement that is not discretionary, but based on rules and long-term research and studies, how to translate that into a formulaic index or strategy approach. And that's really what intrigued me, because by being able to translate, let's say, economic fundamental approaches in the commodities market, to translate those into a systematic strategy, allows to take out all the discretionary, emotional, behavioral, finance aspects that otherwise discretionary traders would be impacted.
Absolutely. I couldn't agree more. Vishal, what about you? You studied, engineering in India. What got you interested in finance?
Yeah, I think that's a very good question. Sometimes I also ask my question to myself as to where and how did I land up in this particular stuff. When I graduated from IIT, quantitative trading was thing that I never even heard of. And that was not in my plans. Not even heard of, not even aware of, like there's something like this that happens. But it's stroke of luck around 2004, 2005. Being in UK, I was looking at the ways of investing, like got some savings, like looking for some investing. And that was the start of it, like started looking into it, but with the proliferation of computing power available through the laptops and availability of data, I started using my technical skills to understand it. Like, okay, how is it something more? Is it something less? What happens? It was some very basic questions, and started reading more as such. And the curiosity just built upon and on and on and on. And it just so happened that there was a big financial crisis in 2008, 2009, that just basically opened my eyes. And I saw the returns of the systematic managed futures. And it so happened at that time I was working with the Visa Europe and the technical part of the things as such. But then I switched over a career and joined Iron Asset Architecture. Just a brief, I think when you said in the introduction, Iron Asset Architecture was a hedge fund here in UK, not a prop shop as compared to ARB. But so, yeah, in 2009, I joined Iron Asset Architecture, and the primary focus of Iron was into short-term trading. And that was my first job, and that's where I got initiated. And somehow after that, it's been just... it's a very, I don't know where to put the single stuff, how the things happen, but sometimes just things roll on, and suddenly you find it a different career. And 15 years back, if I look at it, it's been, okay, not something that I had designed, thought, I don't know.
Sure, you just stuck with it. It's good. Now, Tillmann, you have a strategy that's, I think, live since 2015, I think is the date I mentioned, called the J8 Global Absolute Return Strategy. And maybe if you could give us some background on that strategy, how you developed it, and how it differentiates from other CTA-like strategies, that I think would be really helpful.
Yeah, well, the Global Absolute Return Strategy really comes from the idea that, as Pharma and Fresh say, there's no free lunch in capital markets other than diversification. And while asset class diversification is quite well known in portfolio construction, such as the infamous 60-40 portfolio, What is less well known is that you can also diversify across model risk. And if you weight the signals according to the risk assigned to a signal, that you get an additional diversification boost. So what I try to achieve, or what we try to achieve in our methodology and construction, is not to be only diversified across capital markets that are uncorrelated to itself or have low correlation to itself, to other markets, but also to be diversified across the various different return drivers and model components that we use in our construction of those strategies. And what we resorted to is, instead of constructing one big monolith, let's say, for example, the trend following strategy that then has a number of filters in to react to other market environments that may impact the trend following. Instead of doing that, which many CTAs do, instead of doing that, what we did is we decomposed all those different possible return drivers within a market, create a single strategy for each single return driver and risk component that we want to extract. And only after that, combine all these different sub-strategies and risk drivers in a risk-weighted portfolio together to then get a very balanced overall return profile. So just to give you an example, we have in the commodity space 3 independent strategies. One is a trend following strategy. The other one is a term structure arbitrage strategy. And the third one selects commodities based on inventory fundamentals, which you observe on the curvature of the commodity curve. And here you can already see, because we have 3 strategies, or 3 distinct strategies that extract different drivers in the financial markets on the same underlying markets, you already see that the signal that we generate for a single market is actually composed of 3 components. But instead of putting everything into one big monolith strategy, where one may lose the oversight of where that actually return or drawdown come from, we decompose it and thereby enjoy the granularity to observe and to refine our strategies over time per risk driver. And this, I think, is a huge benefit to over many other programs, because we really try to not only understand, but to distinctly extract these factors. And each single sub-strategy that we construct, therefore, really consists of only one single degree of freedom. Is, let's say, complexity and the simplicity, if you want to put it this way. Yeah. So we use a lot of simple underlying construction modules to assemble an overall complex product. But the single parts that go in are very distinct and very discrete, or the return drivers that we try to extract, and on the parameterization side, also put on a very simple footing.
A couple of follow-up questions, Tillmann, on that. On your website, which is publicly available, so we're not disclosing any secrets here, I can see that there's a total of 8 strategies that you're trading, 4 trend following strategies, and then there's 4 arbitrage or carry-based strategies. On these trend following systems, it says commodity trend following, currency trend following, bond trend following, cross-asset short-term momentum. Are all of these different systems in terms of design, or do they, like, would you trade the commodity trend following system in the same way that you're trading the currency trend following system, or do you specifically adjust the rules or the parameters for the currency trend following system to work differently than for commodities or bonds?
Well, the underlying logic for the trend following systems in commodities, currencies, and bonds is the same across all 3. But then for each single market, so for example, for the Euro FX market, or the oil market, or gold, or the government bond market, let's say the 10-year US Treasury or the German 10-year US Treasury, each single market has their own parameterization. So we look at each market individually, but the underlying, and we determine the market-specific parameter individually, but the overall underlying methodology, how we calculate the trend following signal, that is the same for all trend following markets. Now, you mentioned 4 trend following strategies. I just mentioned 3. That is because the 3 trend following strategies on commodities, currencies, and bonds are the original, let's say, long-term trend following strategies that were included in our program from the start. And we recently added the short-term cross-asset short-term momentum strategy, which is Vishal's strategy. And the beauty of this strategy is that because it's so short-term, it kicks in with returns and with a hedge component, where our long-term strategies may suffer drawdowns during reversal periods. But I leave it to Vishal later to elaborate on his system, how that works in exact practice.
Absolutely. Looking forward to that. Before we get there, notably absent from your trading universe are equity index futures or equities in general. Why is that?
Well, what we found is that equity indices are per se a very different animal than, let's say, a single commodity underlying. So, for example, if you look at the liquid futures on equity indices, such as the S&P 500 or the Euro Stocks or DAX or Nasdaq or Nikkei 225, what you see with all these indices is that they're composed of a number of underlyings that go into the index. That's clear. But they also do have a survival bias within the index. So only those companies that do well over a certain period of time, over a certain threshold, those companies are included. And companies that don't do well drop out of the indices. So you do have a survival bias within those indices, which distorts, let's say, the long-term nature of a trend-following approach, where you try to go through the entire economic cycle of an underlying. So let's say oil or gold, you can go through the entire economic cycle with long and short signals. Here, the signals are forcefully truncated in that sense by excluding or including companies. So the survival bias is one of the aspects why we don't trade it. And the second aspect is that most of these companies, or probably almost all of these companies included in these indices, they do somewhat rely on a financing structure, which is reflected in interest rates. And we do trade interest rate futures in the bonds markets. These companies, they rely somewhat on international trade, so on FX. We have already FX strategies in our portfolio. And they rely somewhat on input, be it energy or be it a raw material, commodity to produce something. But in one shape or the other, most companies rely on a commodity input to function. And unless, of course, they're a service company. But why we don't do equities? Because we say, okay, we want to avoid redundancy effects or resonance effects by trading equities on top. It will just be triggered by movements in the underlying markets, which we trade already anyways. So that's another reason why we exclude equities. So the two first reasons that I mentioned is essentially the survival bias inherent. The second is that we already trade all the other input factors that go into equities anyway. And the third factor could be, one could argue that once a stock is issued by a company, it is a 100% speculative instrument, and it does not really serve any more economic function to the firm itself, other than paying dividends to the shareholders and raising the initial capital. So it's a 100% speculative instrument, which is simply traded on the market speculatively. whereas a commodity, for example, is a real input material into commodity into production, into the economic life cycle. So there's clear demand and supply, and all these arguments put together convinced us to not include equity indices in the long-term trend-following space, because we found that those moves are well respected or well thought in the other markets that we already trade. That is not to say that trading equity indices does not make sense if you trade them differently. And again, I want to point to Vishal, who will come in later, who introduced equity indices in a very different fashion, where it makes perfect sense to trade them that way. But in our long-term, slow momentum or trend-following approach, we did not find any added value by adding equity indices to our portfolio.
Mm-hmm. Interesting. Okay, so you have the equities excluded at the level of the global absolute return strategy, but we'll come to Vishal's shorter term strategy, and my understanding is you're trading them there in a different setup. Staying with that portfolio, which consists of several moving parts of several strategies that span across trend following, but also FX carry. I think you're trading VIX, there's commodity term structure arbitrage. How do you put all of that together, and how do you manage risk around that?
Yeah, so just so briefly, maybe allude on the other four strategies that go in there. They're essentially arbitrage strategies, either arbitrage of time or arbitrage of assets. So in term structure arbitrage, we simply arbitrage the longer end of the curve versus the short end of the curve. But we also close out the short end when we see that the curve would swing up otherwise in an unsustainable shape. So there's a natural risk management system built into there, similar to the volatility arbitrage trade, which runs on the VIX futures and on the VSTOXX futures, where we also arbitrage the long end versus the short end. It's essentially to benefit and to profit from the roll yield differentials of the futures along the term structure. And then you can say, okay, here we arbitrage time. When it comes to carry trade in currencies and the inventory picker in commodities, there we arbitrage between asset classes. So carry trade is classic, right? You borrow in the low interest rate currency and you invest in the high interest rate currency. Here we do that always versus the US dollar consideration. And we reverse the trades when we observe a sell-off in the market based on short-term realized volatility. And the final strategy in commodities inventory, there we simply observe the markets based on the curvature of the underlying commodities and try to deduce whether they're an over or undersupply, and then we go long the undersupplied one and short the oversupplied one, because we would expect in oversupplied markets the prices to fall and undersupplied markets the prices to increase.
Sorry to interrupt real quick, Tillmann. Where do you get the inventory data from?
So we don't use inventory data per se. We use the price data along the contract term structure of the futures curve. So we look, for example, let's say, where's the price of the December future versus the price of the September future. And then we see which one is higher, which one is lower, which may indicate that you're rather in an undersupply situation or oversupply situation. That's how we read indirectly the state of inventory, because if we would use fundamental inventory data, that is often delayed and then also subject to corrections. So it's not really precise data.
So essentially it's a basket of, shall we say, it's risk premia strategies. You have commodity curve carry, you're favoring backwardation versus contango, these type of things. You have FX carry. One strategy that is interesting in that space or in that mix is your vol term structure arbitrage system. which I presume has something to do with the VIX and or VSTOXX index. Is that specifically a strategy that's looking to be short volatility or short, expected variance, essentially looking to realize or make money off of the equity risk premium, or would you also go long the VIX index occasionally?
Well, that strategy is purely long short on the term structure, and it does not go long the VIX index, which can be in its own right a very dicey proposition. Because if you look long term at let's say rolling VIX futures time series, you will observe that if you look, let's say, at the front months or nearby rolling VIX future time series, you will observe easily that you have annualized losses of around 50-60% per annum, which are purely roll yield losses. So it makes perfect sense to try to arbitrage that out through a short position. But then if you go short the front month volatility, and then you see a 300% volatility spike in the day, that can completely be a catastrophic event to your entire portfolio. So you have to hedge that risk and to manage that risk. And we are very fully aware of that risk, and our systems are designed to mitigate it.
When you put all of these systems together, how do you allocate risk among them? Do they all have a target volatility or like a target value at risk or something along those lines?
Yeah, that's a very important question. I mean, there's several ways how one can construct a portfolio, and what we have found is if we simply take the inverse of the realized volatility of each of the systems and then weight it proportionately, so essentially equal risk weighted asset allocation, what we found is that this gives us the greatest stability of the overall return portfolio. So we do not use correlations or other or let's say short-term good performance to over or underweight, to put in tilts to over and underweight certain assets. We don't do that. We simply go by the realized volatility, because we found that the realized volatility between assets is fairly stable over time, whereas of course correlations or short-term outperformance of certain strategies to then overweight them, that can be quite short-term or shorter-termish and unstable. And in order to avoid oversized drawdowns, we don't do that. And as you can imagine, with having all these different strategies in a portfolio, you already have a super diversified return stream, and the return and the volatility gets lower and lower and lower. But the beauty of trading futures is futures are unfunded, so you can very easily scale the futures or the exposure to a target volatility. So what we try to achieve is we scale the exposure of our futures to achieve a realized target volatility of 10%. And that actually has worked very well over the last 10 years. I think we have a realized volatility of 10.26%. So it's very close to it. You're never perfect on it, but it's a target volatility. So just to put this into perspective, so for example, if an investor says, okay, I want to invest 10 billion into the strategy, then we would trade the strategy as if it was a 10 million allocation. But how we go to it is we look in the internal exposure calculation to get to the target volatility of 10%, which is probably, for example, 300. Yeah. So that means that the 10 billion will be traded as 30 billion in terms of notional market exposure in the market. And we found that over the period of time, we just need to use between, let's say, 6 and 10, sometimes 12% margin to equity. So let's say 10% margin to equity. So we can trade this 10 million portfolio with a 1 million cash allocation to the margins. And so that means that with 1 million cash, you actually control 13 million market exposure. That is how our risk weighted then works in practice.
Absolutely. Now, maybe the final point on the global absolute return strategy. By what you've described, it's a multi-strat setup, which you yourself put J8 into the kind of like CTA box and see CTAs as your peers. So would you rather compare yourselves to, say, multi-strat pot funds, like a multi-strat quantitative hedge fund? Because in a way, that's what you do. You don't have a puristic trend following setup. You're trading a total of 8 strategies across, different styles, holding periods, long, short, arbitrage focused, trend focused. Is the best benchmark for you guys a multi-strat hedge fund?
Also tricky question. When we embarked on our journey back in 2012, when it started, I conducted 3 global surveys, about the empirical surveys, what the whole CTA industry is all about. And I created a questionnaire and sent this to brokers, to other CTA managers, to consultants, and to investors, and asked, in their opinion, what do they think CTAs are all about? And lo and behold, we collected about 120 replies over these 3 years, and if you put the most common answer of these replies, the most common answer what they say it's all about, if you just throw this into a very simplistic index model, you will see that this index model broadly, to let's say 80% of its returns, broadly mimic or go or are similar to popular CTA benchmark indices, such as the SocGen CTA index or the top 50 index from Barclay Hedge. And what this really educated us on is that, broadly speaking, the most CTAs, or what is perceived as the CTA universe, is essentially a highly diversified portfolio trading on a 12-month momentum, which is risk-weighted, broadly speaking. So if you ask, are we a CTA in the traditional sense? I would say we are 50% traditional CTA, 50%, let's say, alternative risk premium. So CTA plus, I would call it a CTA plus. And if you're multi-strat, yes, we are also multi-strat, but you could also say that we are heavily commodity focused with other asset classes joining it. So it's very difficult for me to put us into a fixed bucket directly.
Now, Vishal, I guess one of the pluses is you with the recent addition of your short-term systematic system, which, as we've learned from Tillmann, does trade equities. If you could, give us some background on what it does and maybe together with Tillmann, why you've decided to integrate it into the global absolute return strategy.
Yeah. If I look back at how I started the whole my trading career and people that I was associated with, I learned quite a lot on the short-term trading side of the things. So this strategy is like a culmination of a lot of learnings as I gained over the years and my own experiences of trading. And this strategy is primarily focused on short-term. The short-term defined as anything from like few hours to few days. So that's we're talking about. So we are not talking about month or anything like that. So a major part of the trades currently are closed within the day or maybe the next day. Very few of them are being held over like multiple days, which can be like 3 to 5 days. But that's the kind of a horizon we are talking about. And this strategy is focused on the big futures, the futures which have good liquidity, which are easy to get in and get out because of the short-term nature that we should be able to trade it with sufficient liquidity. And the base of the strategy is all about exploiting those extreme movements, or not even extreme, we talk in terms of like breakouts being measured in terms of volatility, being measured in terms of prevailing trends, any kind of big impact, those kind of like supposedly big movements measured in terms of the whole context of the market, and reacting to that in a short-term basis, like we are able to get there quickly in a way that we are sampling the market every 3 minutes to 5 minutes. So that's in a very short summary, you would say that, okay, we're sampling this market on a 3 to 5 minute basis. We understand what's the current context in terms of trend, volatility, positioning as to how it is. And if there is any big movement, we would be looking to get onto that movement. Obviously, the trade size and other things are all computed, have their own computations as such. But yeah, that's a brief summary of the short-term strategy. It is applicable to all kinds of asset classes in our simulations, and currently also we trade practically all asset classes as such. The equities, which GAS doesn't change, the main program doesn't change, doesn't trade, but we, in the short term, we definitely trade it. Commodities, currencies, bonds, we're trading across these asset classes as such. And the particular question of how does it fit into this, the GAS as such, that's very interesting. That's where myself and Tillmann, we started talking about it, and overall we did a lot of simulations. And what we realized was that this kind of alpha that I'm getting from this strategy, it's unique in its own way. So before even addition to the curve, what we have been looking at it is like this correlation of the short-term strategy to any of the CTA indices available across the board, whether to S&P individually or to other industry benchmarks, is quite low. In fact, some of them are quite a bit negative also. And we do not find any kind of strong correlation with any of the existing these indices. And this was also held true when we added this particular short-term strategy to the global GAS in our simulation. And we found that it just enhanced the whole risk-adjusted return. So there are multiple ways in which we are looking at it. And obviously, as a whole development of the program takes place, there has to be return drivers from multiple sides, multiple angles, multiple perspectives, without necessarily having commonality or anything like that, or even in the time frame or even in the approach. And this particular stuff blends in very nicely with that program, which is a bit slow, looking at a longer term picture. This is looking at a short term picture, completely different as such. Yeah.
By the way, listeners, I think we should mention when Vishal says, or he mentioned GARS, that's the Global Absolute Return Strategy. And I think what I omitted to mention is that the short-term system that you've been just speaking about is called the Redwood strategy.
Yes, Redwood or RWS, as we say.
Okay. Let's maybe stick with Redwood. What is Redwood's correlation to the short-term traders index, the stock short-term traders index?
Yes, we ran it and we found it practically nothing. It's like very close to 0. Those numbers are pretty low as such.
Are you trading using intraday data, or is it based on daily bars and you may exit or enter a position on the next bar?
Yeah, it's completely intraday. As I said, we are sampling the market every 3 to 5 minutes. Different systems sample at 3 minutes, some sample at 5 minutes. So practically every 3 to 5 minutes, computations are done and the output is generated. That doesn't necessarily mean that a trade has to be taken, but we are completely in tune with the market in that sampling period.
You're trading long and short, I guess, both sides.
Yes.
Is most of it based on exploiting or continuing with a trend that you have observed, or is it more around, counter trend and mean reversion trading?
No, yes. So again, this mean reversion, counter trend to trend, it all has to be in the context. The longer term trend may be like going up. When I'm looking at the market at this particular horizon, it may be coming down. So now a longer term horizon trading strategy may say that I may be going with the mean reversion, but actually in my context, it's like the prevailing trend that's there. So my trend is defined in a slightly different way than the long term trend, or as to how, and that's one of the beauty of this particular strategy is like, it has its own context, and context is not just about the trend, the volatility that is currently there in the market, and all these things need to be taken into account.
Okay. How many markets do you trade there, Vishal?
Currently, there are 12 futures that we trade.
Okay, 12. And how many trades on average would you get in a given day? How active is the strategy?
Strategy is okay. I would say we are talking about 700 round trips per million per month kind of stuff.
Per month, not per year, but per month. 700 per month.
Yeah, something like that.
So 8,500 or something like that per year.
Yeah, per year on a million basis, on per million.
Okay. So in terms of transaction costs, slippage, bid offer spreads paid, etc. Like if you, I'm sure you've done the numbers. Like if you say, okay, I'm down how many % before the year even starts because this is my expected transaction fee drag, cost drag, commission drag.
Yeah. So commission drags, we have noticed we are not in percentage terms, if you're looking at it, I don't have the exact numbers with you at this present moment, but it's not anything substantial to say that the strategy is impacted by slightly varying transaction costs that we have, like multiple brokers with which we actually currently execute.
Interesting. Right. So how does it perform in terms of like risk-adjusted returns when you compare it to the other systems you run? Is it a strong outperformer in the sense that it has higher Sharpe ratio or a better MAR ratio, lower drawdowns? What would you say?
Yeah, it has a higher Sharpe ratio. Returns wise, it's on the par or slightly better, but comparably, the Sharpe ratio risk-adjusted return is quite better. So that's one of the big things, and that's quite evident from the fact that if you go short term, you should be able to react to market changes early as such. But the real challenge in the short-term stuff is to avoid whiplashes, because there's a lot of noise in the short-term space, and that's where the challenge lies.
Okay, so I'm just, this is interesting. I'm so interested in the short-term trading systems because of the fact that they can be so diversifying, right?
Yes,
all the other
absolutely.
things.
Yes, that's the key thing. If you start to go deeper into the stuff, each market, they present their own nuances, and it presents a whole list of, opportunities as such. Yeah.
I was just, so I have a little back of the envelope calculation here. If we're just, very generously saying that there is an execution commission of 75 cents and there's always exchange fees, whatever, 50 cents and clearing fees, 50 cents. So let's stay very competitive, but you always have some, unless you guys have massive HFT infrastructure or exchange memberships, market impact is a thing, and there is a bit off a spread and there is slippage. So let's say per contract, it's also generously $5, right? So if we say it costs you about $6 to trade a contract, would you say that's fair enough if it includes slippage and bid offer?
Yeah, $6 if it includes bid and offer. Yeah, that would be okay. Yeah.
Then when we do these 8,000 round turns per million per year, you're down about 11%, 10.8% to be exact in terms of expected execution and implementation costs. So that is the hurdle you have to overcome, which is, kind of like the genesis for my question is the risk-adjusted returns and all of that. They need to be very, very high. It needs to be an extremely good system in terms of accuracy and all of that. To make back that drag and then some.
Yep, you're absolutely right, and that's where the whole thing comes up. That you will have to, or we will have to control. How much we do not want super sensitive systems to say that we are going into the market as such. How we control the exposure, and the biggest challenge, as you rightly pointed out, is if you trade, you can easily do over trading in the short-term space, and you do not want to get into that space.
Yeah. What are the fail safes and all the kind of tech and infrastructure controls that you're running around the system, given that you're now sampling? Did you say every 3 minutes or 5 minutes? I think you said 3 minutes.
Different markets sample at 3 to 5 minutes.
Right. So it's essentially a 24-hour a day process that needs to run reliably. How do you make sure it does? How do you support that? And yeah, what do you do if it doesn't work? I guess every once in a while there is a glitch. I mean, nothing's ever 100% perfect.
I think that's the other dimension that is part of anything that you'd start to do, like short-term trading. Like there is no off hours, or there's nothing like, okay, you can take a step back. So yes, for this particular thing, like we have built our own in-house infrastructure for the fix execution that we are currently, like all of the systems, currently there's completely automated. The signals are generated and they are fed into the fix infrastructure where they're executed automatically, or like algorithmically as such. And as far as the monitoring of the systems is concerned, there is whole mechanism of producing alerts, and there are the operations desk. We also have one operations desk in India that we currently have the whole monitoring being done from there. Also from the UK, we have the whole thing here. So yeah, we have monitoring in place. We have built the in-house infrastructure. We know the code, like what has been there, and yeah. So from that perspective, yes, this is a kind of an overhead for having the complete end-to-end automation.
Yeah. What language are you guys coding in? Multiple, or do you have one favorite?
Yeah. So it's a multiple. It's a hybrid part of Python, Julia, and Java. So there are parts which are in Python, there are parts which are in Julia, there are parts which are in Java.
Okay. Tillmann, what would you say in terms of like next steps, near term, maybe longer term strategic outlooks for J8? Are you on the lookout for more of these diversifying very different types of systematic strategies for you to integrate into the global alternative or global absolute return strategy? Or what's the future direction that you foresee for your company?
As a J8 Capital Management, we have really two pillars of business. One is our investment management business, where the Redwood strategy and the J8 strategy in all its variants played a key role. And we also have a regulatory hosting business where we provide a regulatory umbrella to other managers and financial service providers. So we are growing both sides of the business with overlaps, such that if you see, for instance, a trader that is under our regulatory umbrella and we get to know him really well, and we think it makes sense for us to integrate him into our system, we may give that trader an allocation. But we are not actively out like a multi-strategy program to always try to source the next best trading idea for integration, because we very much do our own research and are very much convinced that what we have is actually quite good in its own right. But if it just so happens that we come across a trader that offers something that we have not considered or that we cannot do ourselves, then certainly there's maybe a space. I mean, as I said from the very start, our objective is with the J8 Global Absolute Return strategy is to provide the investor with access to the asset class systematic in a broad and diversified and all-encompassing, inclusive, holistic way. And if you can improve that, the better. So that's really where it goes. Where we see the company growing is at the moment we are around 100 million AUM. If we take in our other mandates together, we are around roughly 150, close to, which will expand soon more. And our objective is, while we do at the moment primarily managed accounts, our objective is to launch a fund vehicle that is open to global professional investors. And for that purpose, we are also still looking for the initial money to get it off the ground. But there are promising talks in the pipeline.
Great. Well, best of luck for both the future fund and getting these capital raising talks completed successfully. maybe this is a good ending point to wrap it up. We've heard about the outlook. Thank you, Vishal, for describing to us the benefits of the Redwood short-term trading system. I think we've learned in quite some detail the workings of the global absolute return strategy about your firm. So Tillmann and Vishal, thank you both for joining me on the podcast today. It was a real pleasure to speak with you, and I'm sure our listeners will find our conversation both interesting and valuable. At least that is the hope. And last but not least, a quick note to our listeners. As usual, and as you know, we'll include the most important takeaways of today's discussion in our show notes. Should you have any questions, be that for me, for Vishal, for Tillmann, please go ahead and just send us an email to info@toptradersunplugged.com. We are always very happy to respond. So thank you for listening, and until next time on Open Interest.
Thank you, Moritz.
Thank you, Moritz.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.